Good evening, students. Good evening, Shankara. Good evening, Mansha. Mansha, I'll take up your question. If board meeting decisions are taken online, then the location of the head office will be considered as poem. I could revise only one circular. Yes, Mansha, you are right. That in case the meetings are held online. See, Mansha, there are two things into it. It's not that if the meetings are held online, directly you will not be able to say that the location of the head office will be the place of the effective management. It's not like that. So if you read the guidelines of 2017, the CBDT guidelines, what they try to say is that, first of all, they say that the location of the head office is a very important factor for the poem, because usually it is the place where the key decisions would be taken up. However, you straight away cannot come to the answer that the location of the head office is always the poem or will always be the poem. So, if the company is a smaller company where the company is very centralized, all the decisions are taken up at one single place, they have one head office, they do not have many offices across the world. So then, and plus, if you look at the under the GST also, or under the other laws also, where under the income tax also, where they declare that this particular head office is the principal place of business or the headquarters. There may be certain branches in different jurisdictions, but those branches are doing certain kind of work for the business transactions, but there may not be the place where the key decisions are being taken up. So it's a very centralized structure where the head office would be usually taking all the decisions. The management is sitting over there. In that case, you can say that yes, the head office is a place of effective management. However, where the company is very decentralized, where there are management being sitting across the different jurisdictions, then the company's head office would be the location, because in that particular case, in case of a decentralized business, it's not easily identifiable where is the head office. So then you need to see that where the managers are being predominantly based, where they normally sit, where they normally meet. So then it is also possible that the meeting may not also be the central place. They may operate from different locations via telephone, video conferencing. They may not be even physically present in a particular location. Then in that case, the guidelines say that it would normally be the place, the head office would normally be the location where the highest level of management is situated. So quite possible, let's say the CEO of the company is sitting in US, always in the head office. The CFO is always sitting in US. And then there are certain other board directors. One is operating from Australia, one from China, one from India. And they always attend through video conferencing. Then in that case, one can say that, okay, the head office is where the CEO, CFO are sitting. However, it is also possible that because of the technology, the decisions are not being taken up from one single place. Even the CEO and MD does not come to one office. They are present at different locations. In that case, where the directors who are taking these decisions reside will be the point. Is that clear, Mansha? Good evening, Viraj. Okay. So, yes, I will give a brief overview of 115JH also. So, basically, if we look at it, students, what we discussed in the last class, I'll quickly recap for everyone. We started with the residency concept, right? We started with the residency concept. So, in that, first we spoke about the individual. There are two basic conditions, student. The first basic condition is that you should be staying in India for more than equal to 182 days in the current previous year, or stay in India for greater than equal to 60 days in the previous year, and stay in India for greater than equal to 365 days in the 4 preceding previous year. So there are two conditions. Either of the conditions you satisfy, you become a resident of the India. That is number one. Then secondly, you need to see that whether you fall under the exception, students. The exceptions are given. What are the exceptions which are given? That instead of 60 day, you will only consider the 182 day condition A, where Indian citizen is going outside India for the purpose of employment or is leaving out India for the purpose of joining as a crew of Indian ship or a crew member of Indian ship, or Indian citizen or PIO who being outside India comes on visit to India having the total income from other than foreign sources less than equal to rupees 15 lakh. You have to consider 120 days instead of 60 days when there is Indian citizen or PIO who being outside India comes on visit to India plus having the total income from other than foreign sources greater than rupees 15 lakh. In that case, you also need to check the condition whether the stay in India has been greater than equal to 365 days in the 4 preceding previous year. Right? And then there is deemed residency. Deemed residency says what? Indian citizen having the total income from other than foreign sources greater than rupees 15 lakh and who is not liable to tax in the country of residence, in the country of residence by reason of his residence. So then you become the deemed resident. Now there are additional conditions. What are the additional conditions? So if you satisfy both the additional conditions, you are ROR. Otherwise, you will be RNOR. For ROR, it is resident in 2 out of 10 previous years and stay in India for greater than equal to 730 days in 7 preceding previous year. Then you will be ROR. Otherwise, you will be RNOR. A deemed resident, always a RNOR. An Indian citizen or PIO who being outside India comes on visit to India having the total income more than rupees 15 lakh from other than foreign sources, he will be RNOR if his stay in India during the previous year is greater than equal to 120, less than 182 days. Only this condition. The other conditions need not be checked for deemed resident and the Indian citizen having more than 15 lakh income who is coming on visit to India. Then we said in respect of an Indian citizen who is a crew of the foreign bound ship, then the period entered in the continuous discharge certificate for leaving the India in respect of joining the ship and till the signing of the ship will be excluded. Right? For HUF, again, it is dependent on the control and management. If the control and management is wholly or partly in India, it is a resident. The Karta of the HUF will decide the ROR or RNOR status of HUF. Similarly, for partnership firm, AOP, BOI, LLP, it is going to be the control and management wholly or partly in India. And finally, coming to the company, it is Indian company, is always an Indian resident, or secondly, it was the place of effective management in India. What is the place of effective management, students? Place of effective management means the place where the key management and commercial decisions in substance that are necessary for the conduct of the entity are as a whole are in substance made. Then the companies which are excluded are having the turnover or gross receipts less than rupees 50 crores. Those are excluded. You need to decide the CBDT circular says. So this is coming through the CBDT circular. What is coming through the CBDT circular? This. It gives the guidance, which says you need to check the ABOI test. What is ABOI test? If the passive income, total passive income is less than equal to 50% of total income. Passive income is interest, royalty, capital gain, dividend, rental, plus income where purchase and sale both are from AE. Asset test, total assets in India, less than 50% of total assets. Then employee test, employees situated or resident in India, less than 50% of the total employees. And finally, the payroll expenditure test. So, payroll expenditure of the employees situated in India is less than 50% of the total payroll expenditure. Right? Now, if the ABOI test is satisfied, there will be a presumption that the poem of the company shall be outside India if the majority of the board meetings are also outside India. And in case the poem is, in case the ABOI test is not satisfied, then you need to ask two questions. Who is taking the key managerial decisions and where are those decisions being taken up? Is this clear till now, students? Yes or no? Yes, students. Is this clear? When to apply condition of 7 years, Viraj, the condition of 7 years is an additional condition for ROR or RNOR determination. Fine? Okay. Then we saw once the poem is said to be in India, then there is a notification which is issued in relation to the transitional provisions under 115JH by the central government. What does this notification say? How do you determine the opening WDV? Because there are transitional provisions to be notified because this company is becoming the resident of India. So for the first time, it will claim depreciation, set off of the brought forward losses, all of that. So basically, how do you determine the WDV? As per the tax record as on the first day of the calendar year, first day of the previous year. If it is not assessed in the foreign country, then as per the books of accounts. Again, similar way, brought forward losses or UAD as per the tax record or the books of accounts if it is not assessed to tax as on the first day of the previous year. Now, the losses will be allowed for the remaining period as per the Indian law from the year in which they first occurred. Business loss and UAD shall only be allowed to be set off against the income of the foreign company which is getting chargeable to tax in India on account of it becoming the resident due to POEM. So basically, I gave you the example. The foreign companies income, let's say interest income, royalty income, business income, which is earned in India is any which way is taxable on the source basis. But there is other income which it is getting taxable. Let's say it's income from Australia, income from US, which would not have been taxable in India. But now because the foreign companies become resident of India, its global income is becoming taxable. So the brought forward business losses will be allowed against only that income, which is 250 crore, which was not taxable if the foreign company was not non-resident. Then financial statements are required to be prepared, and if the calendar year is followed and the period is lesser than 3 months, then in that particular case, you will have to add that period to the earlier calendar year and prepare the financial statements for 15 months. If it is more than 6 months, then it is all right. Tax rate will be 40%. TDS will be under the 195 or the provisions which are applicable for a non-resident. Mansha will talk about what is the difference between income other than foreign sources and income from Indian sources right now. Okay. So let's proceed, students. Now, coming to section 5. See, we started with our first lecture with section 4. Right? What is the section 4? Section 4 is the charging section, students, which says that income of the assessee. Income of the assessee for the previous year shall be charged or assessed to tax at the rates which are given in the Act, in the Central Act, which is either the Finance Act or the Income Tax Act. So it says that where any central acts enact that income tax shall be charged for any assessment year at any rates, income tax shall be charged at that rate for that year in accordance with and subject to the provisions of this Act in respect of the total income of the previous year of every person. So total income is defined under 245. Charging section says that the rate as per the Central Act will be charged on the total income of the person of the for the previous year, earned during the previous year. Now total income is defined under 245. What does 245 defines the total income as? Total income under 245 is defined as the total amount of income. Write down. So section 4 we started with, which is the charging section, which says total income of the previous year of person at the rates in the Finance Act or the Income Tax Act, right? Assessed in the assessment. Now, total income is defined under section 245, which says that total amount of income total amount of income referred to in section 5. computed in the manner laid down in the Act. So this computation in the manner laid down in the Act, you go to section 14 onwards. Right? You go to section 14 now onwards, which is basically the heads of income, the charging section, which is provided in chapter 4. So you go as per the heads of income, or we can write the chapter 4, which is the computation of total income. And then, of course, you will do the set off, carry forward of losses, whatever it takes, right? That is a different story. But this is important, referred to in section 5. Now, what does section 5 says? Section 5 of the Income Tax Act. It defines the scope of total income. So, section 5 of the Income Tax Act talks about the scope of total income. Right? Scope of the total income. So now, if we look at the scope of the total income, so scope of total income is saying that there are scope different for different kind of individuals. For ROR, what is the taxable year? Scope of total income includes income received in India, income received outside India, right? Income deemed to be received in India. Income accruing or arising in India, then income deemed to accrue or arise in India, then income accruing or arising outside India. So in short, for ROR, the worldwide or global income is covered in the scope of total income. Income received outside India or income accruing or arising outside India. Wherever the income is earned, all income will be taxable in India, will be included in the scope of the total income. Isn't it? Then, in the case of RNOR and the NR, there is a difference. For the RNOR, again, scope of total income includes income received in India, income received, income deemed to be received in India, so income received outside India is not covered. Then income, or let me write it like this. I think you can also write like that. You do not delete it. So for RNOR, you can just strike down income deemed to be received in India is not covered. And income accruing or arising outside India, even this is not covered. Except what is covered for RNOR is income which accrues or arises, or income you can write derived from a business controlled or profession set up in India. So you can write like this, except income accruing or arising outside India from or as income accruing or arising outside India if it is derived from business controlled or profession set up in India. So for a RNOR, income accruing or arising outside India is not covered. However, if the income accruing or arising outside India is in respect of the business controlled or profession set up in India. Let's take an example of this. Let's say, for example, there is a person who is a RNOR. Who is a RNOR? Because let's say, for example, he has stayed in India for less than, let's say, 60 days during the year. Let's say in the past 4 years, he has been staying in India less than 365 days, or he has been staying in India in total for less than 180 days during the year. And he has not fulfilled any of the additional condition, or he has fulfilled, let's say, one of the additional condition. So he becomes an RNOR. Now, for RNOR, let's say there is income which is arising in US from a business in setup in US. There's a business income which is arising, let's say from the trading of goods in US. Now, from the trading of goods in US, he is deriving the income. But let's say his business of trading is entirely controlling from India. Controlling from India as in the business decisions are being taken up while he is in India. Just like the way poem concept works. The business policies are set while being in India. There are other personnel which are controlling his business from India. So because RNOR person, what he may try to do is he may try to manipulate his residency in a way that his global income should not be taxed here in India, despite entirely managing or controlling the business in India. Or let's say, for example, I'm a lawyer. I have multiple clients, let's say in US. Now, what I try to do is I shift my residency outside India so that I become the RNOR. And let's say during the year, my stay in India exceeded 182 days. So I became a resident, but I have not fulfilled any of the additional condition. But I'm a resident of India. I'm a resident, not ordinary resident. Now I have all the clients in US. But what I do is, whenever I'm here in India, at that point of time, I decide the policies of my law firm. I decide, okay, I provide the services also from here. I have like interns here in India. I have the employees here in India. So the profession is set up in India. This is not a business. This is a case of a profession. So essentially, my entire business outside India is being controlled from India, or the profession is set up in India, even though the income is arising outside India. So in that case, the Act says that for the RNOR, such income will not be considered as the income accruing or arising outside India. Such income, even though it is accruing or arising outside India, will still be included in the scope of total income. So why ROR and RNOR, two categories were created, student? See, if you look at the additional conditions, when a person becomes ROR, only when he fulfills the additional condition. What are the additional conditions, students? Resident in India for 2 out of 10 previous years, and stay in India for 730 days or more during the 7 preceding previous year. Now, you will become ROR only when you have stayed in India for more than 2 out of 10 previous years and 730 days or more in 7 preceding previous year. Look at the first condition just. So, if you become resident in 2 out of 10 previous year, you will become ROR. Right? If you also satisfy the second condition also. So basically, government is giving you 2 years. Because what will happen is, if I, let's say, become the resident just because I have crossed the 182-day threshold. Let's say my stay, for whatever reason, I had come here for employment, I had come here for, let's say, any business, I had come here for medical reasons, whatever. And my stay here exceeded for 182 days. It should not happen that from the very first year, I will be subject to the tax on my global income. Right? I may have interest income, rental income outside India. On all that, the tax will be imposed the moment I become a resident. If ROR and RNOR differentiation was not there. Isn't it? Secondly, as a resident in the ITR has to disclose the foreign assets. Remember, I had shown you the income tax return in which the Schedule FA exists. If you do not disclose in the Schedule FA, if you do not file your return of income when you are holding the foreign assets, what will happen, students? Remember, we had discussed the implication. What will happen if you do not show the in the Schedule FA the foreign assets? Yes. We had seen how Schedule FA appears. What happens? Faster, student. What happens when you do not show the foreign assets in the Schedule FA in your ITR? Invitation card from income tax, Mansha, that's correct. Summons. But there's one trigger which happens. Let me see who remembers. Namrata, penalty is fine, but there is another additional thing. Non-disclosures of Schedule FA or non-disclosure under Schedule FA of the foreign assets. Let me see who remembers. Yes. Somebody please give answer. It's very easy. In which class did you discuss that? Nobody knows that. Very bad. So, what is it? Black money law. Tax on the undisclosed foreign income and asset. Remember, student, 30% as the tax on the undisclosed foreign income and asset. And ROR has to disclose the foreign income and asset. Right? Now, even the NR or RNOR, if he was a resident in the year in which the undisclosed foreign asset is acquired, or the undisclosed foreign asset is acquired, or the income is earned, right? So in that case, even the NR or RNOR can be covered. So you will have the charge under section 3 of the black money law. Isn't it? And the penalty was 3 times the tax. 3 times the tax. Isn't it? So when you do not file the, yes, Dilip, very good. Black Money Act. Yes, very nice, Dilip. Yes, black money law. Students, this is the interlinkage that will help you studying, not only will help you studying, but practically also, this is how you have to advise also your clients. So you're getting ready for practical experience as well, isn't it? Because CA is one step. After clearing CA, you will be a final doctor, right? So you should be practically ready. What are the implications of the transactions, isn't it? The question can also come in exam around this. So this is how you have to write. Okay. So not penalties, not summons. Those are the things, yes, consequential thing. But it's the black money law, section 3 of the black money law. So if I subject the resident from the very first year, he becomes a resident to disclose the foreign assets, it will be too much. It will be a lot of burden, right? So that is why the government created 2 categories of resident. One is the ROR and one is RNOR. Now, when a person will become ROR, only if he is a resident for 2 years out of the 10 years. So you get a window of 2 years. After you become resident in the first year, you have additional 1 year. So you get a window of 2 years to become RORs, of course, subject to the satisfaction of the second condition of 730 days also. So you get a window of 2 years, basically, right? So what they are trying to say is that this is why we are giving a benefit. Now, you should not take the advantage of that benefit by shifting your residency in a way that you are entirely managing or controlling your business from India, but still, this is the income which is accruing arising outside India, and you are RNO. So that is why the government is telling that, look, if your income is accruing arising outside India from a business control or profession set up in India, it will be included in the scope of totaling. Isn't it? Then the last one is NR. For the NR again, I'm putting the same thing. Okay, for NR, this will not be there. The F point will not be existing. Business controlled or set up in India. See, always understand the international tax or any law in India should have some nexus with a charge. Should have some nexus with the charge it is creating. Here, the charge is the tax, income tax. The charge is the income tax. So there has to be some amount of nexus on the subject on which you are putting the charge. For example, under the GST law, if you see, the charge is the GST. The nexus it creates is where is the consumption taking place. Remember the first class that we asked the question. Under the indirect tax law, you ask the question, where are the goods or services being consumed? Isn't it? Whereas under the income tax, see, the question is, who is earning the income? And in the international tax, you also see where is the income earned. So where is the income earned? So see, if the person who is earning the income is a resident, So the nexus is with the residence of the person. So as I am your resident country, I have given you the resources to flourish in my country. I have the right to tax the global income of yours. If a person is a non-resident, then in that case, I can only tax the income which is accruing or arising or is received or deemed to be received in my country, because for that limited aspect students, you are utilizing the resources of my country. See, as a resident, you are not going anywhere else to earn the income. You are sitting here, you are utilizing the infrastructure over here, you are utilizing the communication services here, all the utilities over here, and you're providing the services or are selling the goods. So income wherever it is arising, I have the right. But if a non-resident is there, I cannot tax the global income of a non-resident. I can only tax the income for which I have provided you the resources. What are the resources I have provided? I would have provided you infrastructure. I would have provided you communication service to the limited extent of the income that you are generating in my country. For the income that you are generating in your own resident country, I cannot tax it. That your resident country will have the right to tax. So for a non-resident, I can only tax, India can only tax income received in India, income deemed to be received in India, income accruing or arising in India, or income deemed to accrue or arise in India. This is wrong. This should be, the cross should be over here. Income received outside India, even here. Okay. So income received outside, income accruing outside for a non-resident, I cannot tax. So if you see, the difference between the RNOR and NR is only with one particular thing. The scope of total income for RNOR and NR is more or less same. Except for RNOR, income accruing or arising outside India can also be taxed if it is from the business control or profession set up in India. So the RNOR is more or less treated like an NR, students. The RNOR is more or less treated like NR. So for the first 2 years, until you become the ROR, by satisfying the additional condition, you are treated like a non-resident. So ma'am, what is the difference between RNOR and NR other than this income from the business controlled or profession set up in India? Student, the tax rates. The tax rates of RNOR and NR are very different. Ma'am, slab rates are same. Students, the slab rates are same. But if you remember, the first class basic concept tax rates for individual, what did we study? The tax rates for individual are different for RNOR and NR. See, resident individual more than 60 years, more than 80 years can claim the higher slab rate, but a non-resident 60 years, 80 years cannot. Right? For them, the slab is 2.5 lakh or 3 lakh. Isn't it? Secondly, for NR, there are special rates of tax, which is what we are going to discuss, which are only applicable for NR, not for R. So a resident individual will include the ROR, RNR both. Who is a non-resident then? We understand, ma'am, that you are saying a non-resident is person who is not satisfying the basic conditions. But the non-resident is also defined, students. The non-residents are defined under section 2, wherein for limited sections, a non-resident includes the RNOR, students. Ma'am, what are you saying? A non-resident includes RNOR? Yes. A non-resident under 230, section 230 defines the non-resident. Means a person who is not resident as per section 6. Fine. And for 3 sections, section number 92, transfer pricing, section number 93, you have learned section 93 and the transfer pricing itself, which is the avoidance of income tax by transfer to a non-resident. And section 168. What is 168? 168 is in relation to the 168 is in relation to the scope. 168 is in relation to the scope, students. What scope you are talking about, ma'am? We didn't understand. See, 168 is in relation to the executors, the scope of the executors. Now, what is this 168, ma'am? We didn't understand exactly. So, see, basically, student, 168 provides that income of the estate of the deceased person shall be chargeable in the hands of the executor of the will. Right? In the executor of the will. In the hands of the executor of the will, the income is chargeable. So, for these 3 limited purposes, the non-resident includes the RNOR. Non-resident includes the RNOR. Are we clear? Or you can just write here for these 3 sections, NR includes the RNOR. Are we clear? So meaning if you have a transaction with an AE who is RNOR, transfer pricing will become applicable. So transaction with, or let me write international transaction with RNOR subject to ALP. Because the non-resident includes the RNOR. Students, the logic is, Namrata, that the RNOR is having the similar scope of total income as the NR. So that there is a possibility that the residents may try to shift their income by doing the mispricing to the RNOR. Because RNOR's global income is not taxable like the ROR. So it is possible a resident may try to shift his income by doing the mispricing to a RNOR. That is the logic. Yes. Shankara, income received outside India would not be taxable. Yes, you're right. Sunny, did you understand? I had mistakenly cut down the point C, but I should have done the point B. So I hope it clarifies your answer. Clarify your question. Okay. Is this interesting, students? Yes or no? So now if you look at it, students, ROR, RNOR and NR. 3 different categories and this is the scope of total income. So basically if I have to write in summary, this is income sourced or received in India. Income sourced or received in India. And same is the case over here, even for RNOR. It is the income sourced or received in India, except, or we can write plus, income arising outside India in respect of business controlled or profession set up in India. Okay, so this is the gist. Now we are coming towards the point. Your question, Mancha. What is the difference between total income from foreign sources versus total income from Indian sources? Now I'll give you the answer. All this while, when we started with the residential status, see, for coming to the scope of total income, you should first determine the residential status, because then only you will be able to derive the scope of the total income. If you do not know residential status, how will you know the scope of total income, right? Now, again, going back to the residential status. For the resident, it is 182 days or 60, 365 days in 4 years. That is the condition. Fine. Instead of 60 days, only 182 days. Indian citizen going outside for employment. Indian citizen going outside as a member of crew member of Indian ship. Third category, Indian citizen or PI being outside India, coming on visit to India, having total income from other than foreign sources. Or consider 60 to 120, having total income from foreign sources greater than 15 lakh. Now, what is total income from other than foreign sources, and why not Indian sources, student? See, if I would have used the word Indian sources, student, what will happen? What will happen? Understand the repercussions. It's a circular loop getting created. 5 is saying scope of total income depends on your residential status. I'm not writing anything. I'm not writing anything, students. So, what is the scope of total income? I've just scrolled up my screen. Sorry, I think the screen was freezed. Students, section 5 is saying scope of total income is dependent on residential status. If you go to residential status under section 6 is telling you that total income from other than foreign sources. Now, students, how will you determine the total income until and unless you do not know your residential status? So, are you understanding? There's a circular loop getting formed. By saying first determine residential status for coming to B. If you go to 6 is saying total income should be either less than or more than 15 lakh for deciding the number of days of stay. This is section 6 is saying. So again, section 6 is saying total income. Total income, you have to go to the scope, because total income will include either the Indian sources or the foreign sources or whatever it will include. What it will include is dependent on 5. Isn't it? For example, for certain non-residents, for the non-residents, certain income are exempted. For the non-residents, certain income are exempted. Now, until and unless I have not decided the scope of total income, or until and unless I have not decided the residential status, how will I decide what is included in my scope? So, the Act creates a loop. But why the Act uses the word income from other than foreign sources? So, if you see for RNOR, the income from foreign sources is included as an Indian sourced income if the income is from a business control or profession set up in India. So, what does it say this? Total income other than the income from foreign sources, meaning income which accrues or arises outside India. So if they would have written the word income from Indian sources, then in that case, what would have happened? You would have not considered the income arising outside India from a business controlled or profession set up in India. But if they are writing the words other than income from foreign sources, then in that case, that is an exclusion, meaning you don't consider income from foreign sources while calculating the total income. So all the income which is accruing, arising, received, deemed to receive, income which is deemed to accrue or arise will be included, including the income from the business controlled or profession set up in India, because that is not considered as the income from foreign source, that will be considered as the Indian sourced income. Are we getting that? So section 6 is saying total income from other than the foreign sources. So while calculating the total income here, you will have to include income arising outside India from the business control or profession set up in India, students. That is must. Only then you would be able to determine what is your total income. Are we clear? Yes or no? Okay, students. So this is the scope of total income under section 5. So with this, we are ending the taxation of the residents. We will again discuss the taxation of residents when we go to the topic of double tax relief. When we will again discuss the topic of double tax relief obligations. That time we are again going to discuss this. Namrata, other than foreign source, see, I'll explain again. Other than foreign source mean what? See, total income other than foreign source, meaning you will exclude the income from the foreign sources, but you will include the income accruing or arising outside India, which is from the business setup or profession, business controlled or profession set up in India. So income from all the foreign sources will be excluded while computing the total income for the purpose of number of days of stay. But you will include the income from the business or profession which is controlled in India. If you want, you can just write it down over here. Include income accruing or arising outside India from business controlled or profession set up in India. Okay, fine, students. Yes or no? Any questions? Any doubt? Okay, fine. Now, students, understand one thing. For a non-resident, only the Indian sourced income and the income which is received or deemed to be received in India or accruing or arising or deemed to accrue or arise in India is taxable. So now we are going to play a focus only on the non-residents. What is income received? What is income deemed to receive? What is the income accruing? What is the income deemed to accrue? All of that is now what we are going to play the focus on. But first tell me, are you clear? Yes or no, students? Namrata, income received or arising outside India is not included. Yes, you are right. Income received or arising outside India is not included, Namrata. That's correct. Only except from the business control or profession set up in India. Okay? Yes? Okay. Now, what is income received? First, we'll talk about the non-resident. What is the income received in India, students? Yes. When can you say that the income is received in India? Yes, students. When can you say that the income is received in India? No, Mansha, that is income deemed to be received. As per section, it is deemed to be received. What do you understand by received in India? So income received in India means income which is credited, the receipt here is in India, isn't it? So income that I'm getting in my bank account, income that I am receiving here in my hand, the first receipt that I have, income accrual is one thing that I have the right to receive. Income receipt is I get that in my hand. It is at my disposal. It is put it in my disposal. Once the transfer is initiated from the transferor to me, I have earned that receipt, right? So income received in India. Yes, when it is actually received, Dilip. Yes, you're right. Credited in the Indian bank account. But here there is a little litigation, students. When you say credited to the bank account, what is the problem here? Understand, students. The problem here arises in the context of many of the non-residents who come on secondment in India. Ma'am, what is secondment? Secondment is deputation, right? They come for a short period of employment here when they are transferred from their one company to another company for certain period. So what happens, students? Or sometimes what happens? There are the Indian residents who go outside India for employment for a short period of time. Okay, they go for employment a short period of time. And they make an arrangement with their employer that look, our family is in India. So we would want to receive our salary in the Indian bank account, even though we are working for the foreign company. So still our family is in India. So, if you give the amount to us in US and then we repatriate back to India, it is going to be too much of task. So can we just make an arrangement that we directly credit the salary to my Indian account? So instead of you giving to me in my foreign bank account, you directly pay to my Indian account so that my family can access that salary. See, if the employer gives my salary outside India, I am a non-resident, the employer gives me the salary outside India. Whether that will be taxable in India, students? Yes. Whether that will be taxable? If the employer gives the salary to me outside India, I am working for a US company, I am a non-resident, and I am earning the salary from the US company. Whether India will have the right to tax? Manish, no. Viraj, no. Dilip, no. Yes, why no? What is the reason for no? All of you? Because NR. Yes, Viraj. Because it is NR earning the income from outside India. and that is not included in the scope of total income. Earned and received abroad. Yes, Dilip, you are right. Absolutely. So, for NR, salary income will not be taxable in India. Now, if this salary was received in my US account, and let's say I would have repatriated back this salary to my family, whether repatriation is taxable in India, I have earned the income in US, I am sending this money to my family. Whether this is taxable in India, repatriation. Mansha, no. Why is it not taxable? Munish, Viraj, why? Why repatriation is not taxable? Yes, Dilip. Because first receipt is outside India. And repatriation is not income. Namrata, that will not be taxable. Repatriation will not be taxable. It is only remittance. Yes, very good, Viraj. It is only remittance. It is not an income. It is nobody's income. It is transfer of funds to family. Yes, very good, Munish. Right? Now, if my employer is agreeing to an arrangement with me that instead of paying me salary in my US bank account, he transfers the salary to my Indian bank account. Now, will that make it taxable here in India? Will that be taxable here in India? Yes, students. Yes, will that be taxable? Munsha? Yes. Yes, as received in India. Namrata, Mansha is saying yes. Munish is saying no. Why Munish no? Namrata is saying yes. Dilip, yes. Why? See, students, here there are two views possible. One view is your view. What you are saying is yes, it should be taxable as there is received in India. Munish, you are saying it is paid for services outside India. No, Munish, that is not the reason. If it is received in India, it should be taxable. But here there is some difference. So income are paid for the services rendered outside India. Now the income tax officer says this should be taxable in India because it is received in India. However, if you look at it, here it is credited to the Indian account for the purpose of and because of the arrangement which is existing. See, ideally it would have been credited to my US or Europe account. But because I want my employer to give it to me in Indian account for some convenience, it is just credited to my Indian account. That does not mean it is received in Indian account. Because the first point of receipt is in US, where the income is getting transferred to me at my disposal. The income is at my disposal in US. It's just because of my arrangement for my convenience, the employer is crediting to my Indian account. So that does not mean it is received in India. Received in India means the first point of receipt, the place where it becomes to my disposal, that is US. So the CBDT has clarified in this regard. You can write down. CBDT clarification. It says that salary accrued to non-resident. So this clarification is given only for non-resident seafarers, not for every non-resident. But relying on this particular clarification, even other non-residents are taking the benefit. And there are judicial decisions backing up that this circular, as it is applicable for non-resident seafarers, can similarly be relied even for the other non-residents as well. for services rendered outside India. On a foreign ship. On a foreign going ship. Whether Indian or not. It should be a foreign going ship. It can be Indian or foreign. With Indian or foreign flag. Shall not be included in the total income. Shall not be included in total income merely because the salary is credited in the NRE account with Indian bank. What is NRE? NRE is the non-resident external account. There are two accounts under FEMA, non-resident external and non-resident ordinary account. Okay? Fine? Yes or no? Yes, students. Any questions? Any doubt? Seafarer means the crew of ship. First place of receipt, Namrata, means that the place where it becomes at my disposal, where I have the right to spend that income, where I get the right to spend that income in US. It is me who is telling my employer to just do it for my convenience directly to the Indian account. Clear? Yes or no, students? Is this fine? Okay. Now, what is income deemed to be received? What is income deemed to be received? For that, we have section 7. For that, we have section 7. So, section 7 talks about the income deemed to be received. And what does section 7 say about the deemed to be received? Let's understand. So, income will not be actually received by me. Income is not actually received by me, but it is deemed to be received by me in these three situations. Where there is interest income which is getting, or the employer contribution which is getting added in the provident fund. So whatever addition is happening to the provident fund is not income that I am actually getting in my bank account, but this is technically my income only. So therefore, if you look at it, the employer contribution, the employee contribution, the interest income is all the income, and that is why you get deduction under section 80C, students. So that is why you get deduction under 80C, isn't it? So why do you get deduction under 80C if it was not your income? Deductions are in respect of incomes only, right? Only when you consider that as an income, you get a deduction. So, employee's contribution is considered as the 80C deduction. The employer, what is contributing? That is though an exempt income, but that is income deemed to be received. Right? So, whatever amount you receive from the employer is exempt. Up to 12%, isn't it? Up to 12%, it is exempt. Are we clear? So the employer contribution is also your deemed receipt. That is section 7 of the Act. So write down income deemed to be received. Annual accretion to the provident fund. So interest, employer contribution, then transferred balance in the recognized provident fund. So if you transfer the balance from one RPF to another RPF, that is again deemed receipt. In a recognized provident fund. Then contribution made by the central government or any other employer to the pension scheme. So though you are not getting this as your income, but this is your deemed receipt. Yes, so these are the three categories for the deemed receipt. Delete for the seafarer this exception. Yes, it is there, but it can also be extended to the other non-resident. Though the CBDT has not given any clarification for other non-residents, but the courts relying on this circular have held that this similar thing should also be there for other non-residents. Okay. Namrata, in short, this particular clarification says that in case of a non-resident seafarer, the income which is arising outside India will not be considered in the scope of total income just because it is received in my Indian bank account. Are we clear? Now we move towards, after understanding the receipt, deemed to be received. Are we clear? So under deemed to be received, three things: contribution to the RPF, right? So whatever contribution is being made in excess of 12%, contribution of the employer to the pension scheme, and amount transferred to the RPF from the unrecognized provident fund. So here it should not be the employee contribution, it should be only the employer contribution and the interest. Employee contribution is not the income. From the, you can write unrecognized provident fund. Now what is accruing or arising? See, accruing or arising, students, is that when is the income getting due to you? So let's say, for example, I am working in a company for the month of, let's say, January. So in that particular case, I am getting the right to receive the income for each day I am working in the company. So every day, even though the salary will be paid to me, let's say on 5th of February. So the salary is due on 5th of February, but the salary is accruing for each day I am working for the company. Similarly, let's say, for example, the interest on fixed deposit. You take the payouts either as monthly, quarterly, annually, or on redemption. So the interest gets due on redemption monthly, quarterly, yearly. But it is getting accrued on all the for the entire period of fixed deposit. Isn't it? So the income is accruing for the source which is lying and which is underlying there for the act that you are performing in a particular jurisdiction. Isn't it? So that is the income accruing. Now, if let's say for example, I'm saying I am a company or so I'm an individual. Let's say I am entering into a contract. I am entering into a contract for, let's say, sale of goods. Now, I'm selling these goods to a US company. But where is this contract getting entered into? I am a non-resident. I am a non-resident. So see, all this while now we are not going to speak about resident because we are talking about what is income received, what is income deemed to be received, what is income accruing or arising. That is not important for resident because for resident, wherever the income is accruing, it is taxable in India. Whether it accrues outside India, whether it accrues in India, for resident, it does not matter. Global income is taxable. You don't need to think whether for a resident income is accruing or arising in India or not. Do you need to think? Answer is no. Income, if it is received in India, accruing outside India, received outside India, whatever it is for a resident, it will be taxable. You don't need to apply your brain to see whether it accrues or arises in India or not. It is only applicable for RNOR and NR, isn't it? So for them, it is important to identify where is the income accruing. So let's say I am a non-resident. I have concluded the contract of sale with another non-resident. So where the income will accrue? Where the contract is getting concluded. So the underlying contract gives right to the income. So the source is the accrual. Where the income is getting sourced, that is the place of accrual. If my contract is concluded outside India, income is accruing arising outside India. If I am a non-resident having a branch in India, my branch is concluding the contract for sale. It is in India, isn't it? If I have a bank account outside India, interest on that bank account, that is received outside India, that is accruing outside India because the interest is accruing on the funds lying outside India. Dividend on the US stock. Dividend by the US company. Dividend is accruing outside India because it is received by holding the US stock. That is the accrual concept. Now, income which is not accruing in India will be deemed to accrue if the Section 9 conditions are fulfilled. So, even though income is not accruing in India, but by virtue of Section 9, deemed accrual will be there. So, this is what we are going to study, but after the break. Because now if I start with, it is going to be in continuity. So we'll take a break over here and then we start with the deemed accrual concept. This is very, very, very important and very interesting, students. Okay, so let's take a break of 10 minutes and then we get back. Let's take a break. Thank you so much, Mansha. So where are you from, Mansha? If you say outside India. Okay. So students, yes, Mansha. Basically, the income tax provisions are um, inserted, are drafted by the finance minister, who have a team of the people who are working for the finance minister. So it's being done by the Ministry of Finance, wherein they have team, wherein certainly there would be a lot of IAS officer, a lot of lawyers, a lot of chartered accountants involved. Also, basically what they try to do is sometimes they take the industry consultations also, very rarely, which is a need of the hour to be done before introducing the provisions like, tax on the online gaming, tax on the virtual digital asset. It would have been better if the industry consultations were done. Sometimes they do, sometimes they don't. Most of the times they don't, I would say. But yeah, the income tax provisions are drafted in this particular manner. Yes, tomorrow is the interim budget, a very, very indeed important day. But as it is going to be an interim budget and the final budget would be after elections, yeah, so basically it's worthwhile to watch. Let's see what comes out tomorrow. Yes. Okay, students, so just let's get started with section 9. Okay, so section 9 of the Income Tax Act. It's a deemed accrual concept. Now, what is all included in section 9? Let's try and understand one by one. So first under section 9 is section 911, which is in relation to the concept of the business connection. So just write down. Sorry. Nine one one business connection. A, transfer of capital asset situated in India. Third, source of organized source in India. Okay. Then we have section 912. We have section 912, which is salary. Section 913 is dividend. Section 914 is interest. Section 915 is, sorry, 912 and 913 are both salaries, my mistake. So 912 is for the salaries, 912 is salary by government. 914 is dividend. 915 is interest. Section 916 is royalties. Section 917 is fees for technical service. And section 918 is gift. Okay. So these are the sections that we are going to cover. First, we'll start with section 911. What does section 911 says? Yes, Dilip, tomorrow we have the budget and please watch out for that. Of course, the amendments which will come to the budget will not be applicable for your attempt, but it's always important to watch the union budget. Yes, it's an interim budget. Okay. So basically, first we'll talk about section 911. So this is very, very wide and very, very important provision, students. So section 911 says income which is deemed to accrue or arise in India. All income accruing or arising. What does section 911 says? All income accruing or arising directly or indirectly. Whether directly or indirectly, through or from any business connection in India, through or from any business connection in India, or through or from any property in India, or let's write it like this, that will make it easier for us. Through or from any business connection in India, that is A. B is through or from any property in India, C. Through or from any asset or source of income in India, or through the transfer of capital asset situated in India. Okay. So there are 4 clauses, students. We'll go one by one. Okay. So first is through or from business connection in India. So what is the term business connection? What do we understand by business connection? So students, there is a difference between 2 words. I think we have already discussed this. Doing business in India versus doing business with India. Yes, students, we had discussed that already, isn't it? Yes or no, students? What is the difference between the two? Yes, BEPS, yes, Mansha, we had discussed over there. But what is the difference between the two? Yes, students, master. What is the difference between the doing business in India versus doing business with India? We have discussed that already. Please give responses. And even if you don't remember, it's a very simple question, students. Yes, Namrata, you are right. In India requires premises in India, fixed establishment in India. In India means that I am being present in the Indian jurisdiction and doing the business. Whereas doing business with India is that I am remaining outside India and I'm not coming or establishing any business inside Indian jurisdiction and outside itself I'm doing. For example, normal sale of goods. I may not be required to set up an establishment in India and sell the goods. I can sell even while remaining outside India. That's the doing business with India. Doing business in India requires some amount of presence. Yes, Viraj, right. Mohammed, absolutely correct. With India involves the uh, another country's participation. No, not with India, Mohammed. It's in India requires another country's participation in a greater extent, whereas Mohammed, with India is a very weak connection which exists. I am not participating in the other jurisdiction and still doing some business by remaining outside. Viraj, with India means India is a judicial person for transaction, not judicial person for transaction, not at all, Viraj. It just means that with India means that I am remaining outside India and still doing the business without having any presence, without having any establishment, Viraj. Doing business with India is not taxable since it is not earned in or from India. Yes, Dilip, you're right. That was a thing of past, of course. Now, even with India is taxable, and we are going to discuss how. Yes, Mansha with India is narrower concept than in India. Mansha, it's not broader, it's narrower concept than in India. In India means it is you are required to be present. Your presence should be demonstrated by remaining in India, right? So students, why I put up these two confusing words for you. I'll explain why. Because section 911 says that the business connection should exist. So income accruing or arising. See, accruing or arising is nowhere defined. Even while we are saying that income deemed to accrue or arise, the accruing or arising is not defined, students. It merely says that the income accruing or arising. From what? From any business connection. Now, what is business connection? Not defined. What is business connection? Not defined. Are we clear? So, there are certain explanation which provides the guidance as to what is business connection. Business connection is not defined, students. We have understood the meaning of the business connection by the interpretation provided by the judicial decisions. There is one very old decision in the context of, in the case of the R.D. Agarwal, wherein the court had interpreted the term business connection to mean that there has to be some sort of connection between the activities that are carried out in India and the income that is earned from that. Business connection. Income from business connection. Income accruing or arising from business connection. So, relationship of the activities carried out in India and the income which is earned from those activities. So, there has to be some sort of connection between the activities which are giving rise to the income. Those activities have to be carried out in India. That was some real and intimate connection, and not an isolated transaction, a continuous business activities carried out in India. But the Act does not define business connection. Explanation 2 to Section 911. Talks about the business connection includes. Business connection includes. What it includes, we'll talk about it. So, explanation talks about it. Explanation 2 says that business connection for a non-resident, or not for a non-resident, it's saying business connection includes any business activity. Any business activity carried out through a person who, acting on behalf of the non-resident, includes any business activity carried out through a person who, acting on behalf of the non-resident, A, has and habitually exercises an authority to conclude the contracts on behalf of the non-resident, or habitually concludes the contracts, or plays or habitually plays the principal role leading to the conclusion of contracts. Leading to the conclusion of the contracts by the non-resident. Are we clear? Now, what does this mean? First, we'll write it down, all the points, and then we'll discuss all together. B, habitually maintains in India the stock of goods, from which he regularly delivers the goods. On behalf of the non-resident. And third, habitually secures the order, habitually secures the orders in India mainly or wholly for the non-resident. Mainly or wholly for the non-resident or the non-resident controlled by or subject to the common control. Subject to the common control. Exclusion. An exclusion is there. Broker, general commission agent, or independent agent. Or independent agent acting in the ordinary course of business. Acting in the ordinary course of business if the agent or broker is working mainly or wholly on behalf of the non-resident or non-resident controlled by or subject to common control, he shall not be deemed to be an independent agent. So this is basically the exclusion to exclusion. Now let us try and understand. The business connection, if you look at it, as I said, this is not defined. Right? This is not defined, but understood as real and intimate connection between income and the activities carried out in India. Right? So this is not defined. However, it is understood judicially as having the real and intimate connection between the income and the activities carried out in India. Explanation 2 says that it includes any business activity carried out through a person who is acting on behalf of the non-resident. So not only a non-resident having some form of establishment here in India, but a non-resident who is undertaking the activities not himself but through an agent who is acting on behalf of the non-resident. So there is a term कि facet per annum, facet per se. Do you understand this term? It's a Latin phrase. This term means he who acts through the another does the act himself. He who acts through the another does the act himself. Is deemed to done the act himself. This is the principle which is underlying this entire explanation too. So, a non-resident who is doing any act through the agent, that agent will lead to the business connection for the non-resident. Because if I would have earned this income directly, that would have constituted my business connection. Yes, Namrata, you're right. You have the reference of this term under the contract law, under the Contract Act. The work of the agent binds the, or the acts of the agent binds the principal. The act of the agent binds the principal. So, your explanation 2 is giving you the same particular point. It is telling you that if you are doing any act, through an agent, it will be as if you have done the act yourself. That is the entire logic, students. So explanation 2 says that in case you're concluding the contracts, your agent has the authority and he exercises that authority, has the authority and exercises the authority to conclude the contracts here in India. And he has the authority, he also exercises that authority, but that authority should be exercised habitually. Why habitually word? Because I told you, an isolated transaction will never result in business connection. This term we had also seen erstwhile. We have discussed this term earlier also, if you remember, in the PGBP, fee facet per annum facet per se. Anyone remembers this? This term we had also discussed while we were doing the PGBP. Anyone remembers? See, this is business connection. That's why I'm making the reference to again PGBP. Go back to PGBP notes. Very first class of PGBP. No, section 44. What is section 44, Mancha? No. Yes, Namrata, you remember where was it? Tell me the place. Namrata and partnership firm or directors of the company. No, that was a liability of directors, liability of partners. That is right. But then in PGBP also we have done somewhere. That is in the liability you are talking about. I'm talking about PGBP. No one remembers? Yes, students. In the start of the PGBP, aren't you maintaining your notebook, students? In partnership firm or directors, that was a liability chapter. Yes, students, aren't you maintaining your notebooks? In the case where we were talking about the section 28, I'll take you. Profit and gains from business or profession carried on by the assessee, which includes the agent of the assessee. Carried on the by the assessee, the word by the assessee includes carrying on the business even through the agent of the assessee. Are we clear? Yes or no? So there we have discussed this term. And here also it's a similar principle. So if you look at it, has and habitually exercises, meaning it should be a regular authority which we should exercise. One of the time he exercises authority in some contingency, that's not business connection. That will not lead to business connection. It has to be habitual exercise. And authority to conclude the contracts on behalf of non-resident. Or if he does not have authority, but he still concludes the contract on behalf of non-resident. Concludes the contract meaning, let's say for example, this particular agent is there in India. A non-resident company hires an agent. And this person goes, identifies the customer, discuss the pricing, shows them the products, and then say, okay, deal done. The goods will be sold to you. He will constitute the business connection. But you know what, students? These companies were very smart. They started interpreting the statute by the letter of the law, neglecting the intention of the law. Letter of the law is saying he has the authority to conclude the contract or he habitually concludes the contracts. Okay, let's do one thing. We will not let the agent conclude the contract. We will also not give the agent any authority to conclude the contract. Neither he will exercise that authority. He will not have authority, he will not exercise also, and he will not conclude the contract also. But we will tell agent, you do all the other stuff. From identification of customer to the final price negotiation and final price booking. But we will conclude the contract finally outside India. We will just sign the contract. Whatever price you have agreed with the customer, we will agree on that price and we'll sign the contract. So in effect, the agent is doing all the activities, just not concluding the contracts to come out of the business connection. So therefore, the BEPS action plan identified this as one of the concern which is leading to base erosion and profit shifting in the source countries. And therefore recommended action plan 7, wherein it was recommended under action plan 7 that all the tax treaties should be amended to give effect to the clause that even though the agent is not having the authority to conclude contract, nor he is concluding the contract, but he is playing the principal role leading to the conclusion of contracts by non-resident. He is doing everything, and the contracts are just formally concluded by the non-resident. There will be business connection constituted even in that case. Now, this amendment was carried out in the treaties through the multilateral instrument, through the Web Section Plan 7, and therefore India also amended its Income Tax Act. Because if the Income Tax Act is not amended, it will not be in line with the tax treaty. There's a provision we are going to study which says act or the treaty, whichever is beneficial, will apply to the taxpayer. So if the treaty is amended and the act remains unamended, the provision of the treaty will be provision of the act will be beneficial, and the taxpayer will say there is no provision under the act, therefore I cannot be taxed on this ground. So therefore the act was also amended to bring this in line with the tax treaty. So this is a recent amendment, this particular part. Habitually plays the principal role leading to the conclusion of contracts by the non-resident. Yes, Namrata, it's an appropriate question. For determining the authority, there is need of the documentary evidence because it's very subjective. You need to maintain your email documentation. What is exactly that you are doing? Email documentation here plays a very pivotal role. Okay. Next is habitually maintains in India the stock of goods. He maintains a stock of goods and regularly delivers therefrom. So he is continuously maintaining the stock of goods in India and regularly delivering. One-off transaction will not result in business connection, but habitually or regular activity will lead to it. Or he habitually secures the order. He secures the orders in India by finding out the customers mainly or wholly for the either non-resident or the non-resident and its related entities which are subject to the common control or same control by that non-resident. Are we clear? So an agent will result in the business connection for the non-resident. There is an exclusion provided. Exclusion says broker or general commission agent or independent agent acting in the ordinary course of business. If an agent is there in India who is working for many non-residents, he is acting in the ordinary course of business, he is regularly dealing with different non-residents, that will not be resulting in the business connection. So only a dependent agent who is working for one non-resident, that will result in the business connection. However, they say if there is agent, broker or independent agent who is working mainly or wholly for a single non-resident or its controlled entities, he will not be deemed to be an independent agent because he is working only for one non-resident. Yes or no? Is this clear, student? Yes? Faster, yes or no? Any question? Now, understand this thing. In the next chapter of double tax relief, there is a concept of PE given, permanent establishment, but we are going to discuss now itself. See, for a non-resident, he can also access the tax treaty. What is a tax treaty? So students, remember at the start of the international tax class, I told you what is international taxation. The interplay of the domestic law, Income Tax Act, other law of different jurisdiction of which the other person is resident or where the income of Indian resident is arising, interplay of those laws and the tax treaty in between. What is the role of tax treaty? Students, the tax treaty's role is very, very simple. A tax treaty exists to avoid the double taxation. To avoid the double taxation, and that's why they are called as double tax avoidance agreement, students. Double tax avoidance agreement, DTAA. We also call them as tax treaty. How double tax will be avoided? Through the double tax treaty. So the country of India and the other country, both the countries will enter into an agreement. It's a contract that look, we will avoid double tax in this and this manner. Both the countries will agree that, let's say, for example, if it's a business income, we will agree to avoid the double tax in so and so manner. If it's royalty, in this manner. If it's FTS, in this manner. If it's dividend, in this manner. So the way you have the heads of income under the Income Tax Act, under the tax treaty also, the different income streams are, the double tax on that is avoided in a different manner for different heads of income. Just that under the treaty, you have articles, whereas under the act, you have the heads of income. Now, under any DTAA you look at, for the business income can be taxed in the source country. See, resident country we are not talking about, because as I said, a resident country generally taxes the worldwide income all across the globe. Of course, there are certain exceptions. There are certain countries which do not tax the worldwide income and which only tax the income arising in that country. For example, Hong Kong, Singapore. But generally, the country which is a resident country, of which I am a resident, will tax my global income, the worldwide income. Treaty also respects that. Treaty says, yes, you are a resident country. You are providing all the resources to your resident. You tax the global income. No problem. Now, the double taxation is arising because there is a source of income in another country. I told you that the nexus under the international tax is created on the basis of residence and the source concept. Now, the source country under the tax treaty agrees to limit the taxing right. Let's say under the act, I can tax up to 40%. Under the treaty, I'll agree to restrict at the rate which is negotiated between the two countries. So treaties are essentially a bargain between the two countries. So it depends on how much outflow of the foreign exchanges, how much inflow of the foreign exchanges, what are the trade relations, what are the economic powers, which country is richer. It depends on all of that. So every country you will see will have a different treaty. There is no standardized treaty. Different tax rates have been negotiated for limiting the source country tax rate. Any country can be a source country, wherever the source of income is arising. So for the business income, it is generally seen that the business income can be taxed in the source country where the business income is arising only when there will be a permanent establishment. So under the act, you have business connection. Income accruing or arising, if it is resulting from a business connection, India will get the right to tax. But then you go to the tax treaty. Under the tax treaty, the business income is taxable or not taxable. Business income can be taxed in source country only if there is permanent establishment in source country, or we call this as P. Now, what is my P? P is defined. So the word business connection is not defined, but the P is defined in all the tax treaties. It is defined differently. Every treaty will have a different definition of P. As I said, treaties are bargain essentially. Some countries may have a very wide definition of P. Some countries will have a very narrow definition of P. It depends on the bargain between the two countries as to how the definitions, how the taxing rights are given. Namrata, tax treaty is not a part of DTAA. Tax treaty and DTAA are the same terms. Are both the same terms, are both meaning the same thing, are just basically different words to be used for the same thing. DTAA is double tax avoidance agreement. We can also call it as tax treaty. It's the same thing. Namrata, how authority will know? He plays the principal role, as I said, through the emails, through the signing, through the questionnaire that they send. They conduct the survey, they ask the employees, they ask their customers by issuing the summons. Okay, so business income can be taxed in the source country only if there is a P. Now, P is a defined concept, unlike the term business connection. Unlike the term business connection, P is defined. Now, what does the P mean therefore? The P means, students, as I said, different treaties will have a different understanding. But more or less, Article 5, usually Article 5 of the DTAAs talk about the P concept. Talk about the P concept. So this includes place of management, not place of effective management, a place of management, branch, fixed place of business, through which business of non-resident is carried on. Fixed place of business through which the business of non-resident is carried out. Then office, factories or workshops, then sales outlet. So some treaties may have something, some treaties may have something else. But these are the general things which are included. Warehouse, mine, oil or gas well, or place of extraction of natural resources, then let me put it over here, this side. Dependent agent, like the Income Tax Act, same one who habitually concludes contract or concludes the has the authority to conclude contract or plays a principal role leading to conclusion of contract, secures orders, maintains the stock of goods. Again, under different treaties, we have different definition of dependent agent also. Some treaties will have secure orders, some treaty will not have the secure orders clause. So it depends. Excludes the independent agent. Then construction or installation site or activity. Activities performed through the employees. All of this results in the permanent establishment. Are we clear? So under treaty, we have P. Under the Act, we have the business connection. Are we clear? Yes or no? Any questions? Namrata, no difference between management and effective management. It's just that place of management can be any place from where the management is being carried out, but effective management means with essentially the head and brain lies. Dilip, we are generally referring to Article 5. We are not referring to any country. It is more or less Article 5 in most of the DTWs. Okay? Yes or no, students? Is this clear? Yes? For example, I can show you one of the DTAA to give you a practical insight as to how the DTAAs look like, student. This is India US. This is available on the income tax website. See, look at the preamble. It says, whereas the annexed convention between the government of the United States of America and the government of Republic of India for the avoidance of double taxation and the prevention of fiscal evasion with respect to taxes on income has entered into force on so and so date. Are we clear? So therefore, if you look at, this is the convention between the government of the United States of America and the government of Republic of India for the avoidance of double tax and the prevention of fiscal evasion with respect to taxes on income. And if you look at the Article 7, business profits, what it says, the profits of an enterprise of a contracting state. The DTAA does not use the word countries or jurisdiction. It uses the word contracting states. Just like you read any contract, they write the word contracting parties. Here they use the term contracting state. So the profits of an enterprise of a contracting state. So the profits of an enterprise of a country, an entity of a country which is doing the business, shall be taxable only in that country where the entity is doing the business, where the entity is a resident, unless the enterprise carries on the business in the other contracting state, in the other country, through a PE situated therein. So what it says is the profits of an enterprise of a contracting state. So the profits of an entity which is a resident of the country. So enterprise means a business unit. Enterprise means a business unit. So enterprise carried on by a resident of a country. So profits of an enterprise which is a resident of, let's say, USA shall be taxable only in USA unless the US entity carries on the business in India through a PE situated therein. And now if you look at Article 5 defines the PE. For the purposes of this convention, the PE means a fixed place of business through which the business of an enterprise is wholly or partly carried on. Permanent establishment includes place of management, branch, office, factory, workshop, mine, oil or gas well, quarry or any other place of extraction, warehouse, farm, plantation or other place where agriculture, forestry, plantation or related activities are carried on. Installation or structure used for the exploration or exploitation of natural resources. Building site or construction, installation or assembly project or supervisory activities. Furnishing of services through the employees. Are we clear? Then permanent establishment does not include use of facility only for storage, display or occasional delivery. Maintenance of stock of goods for the display or occasional delivery. Now see under the act, they say what? If an agent delivers, maintains the stock and delivers therefrom, that is the constituting the business connection. But under the treaty, if you see, it says occasional delivery is out. Maintenance of stock of goods for the purpose of processing by another enterprise. Maintenance of fixed place of business solely for purchasing the goods or collecting the information. Maintenance of fixed place of business for supply of information or for scientific research. Then, where a person other than an agent of independent status who is acting in a contracting state on behalf of the enterprise of other contracting state, it shall be deemed to have a P if he has and habitually exercises the authority to conclude contract. He has no authority but habitually maintains the stock of goods and have contributed to the sale. He habitually secures the order. Then independent agent is excluded. So see, this is how the definition of PE is there in different treaties. Construction or installation activity number, that's very simple, that if I am doing the construction activities here for a certain number of days, it will result in P. Simple example. So if you see, if they come for installation of machinery, if they come for, let's say for example, construction of roads, construction of railways, construction of highways, they can result in P. P is nothing but, or P, business connection is nothing but the activity giving rise to the income. If that activity is strong enough to build a great nexus, build a strong connection with the country where the activities are performed, it will result in business connection or P. Yes or no, students? Is this clear? Yes or no? Any questions? Any doubts so far? Okay. Now, in your module, there is one particular term. Liaison office. Liaison office. Now, what is liaison office? So, liaison office, as the name suggests, is the office which is established under the RBI guidelines. As per the RBI guidelines, only after obtaining the approval from the RBI for just a limited purpose, to liaison, to act as a communication channel, between the non-resident and its customer. So this is just a communication channel. It has a limited purpose. Now, whether this will constitute the P, having a liaison office, whether constitutes P. So there are different decisions and it depends purely on the activities which are carried out by the liaison office. So if you look at it, the RBI gives the approval for establishing the liaison office under the FEMA. So it has to demonstrate that it is only going to engage in the selected activity of acting as a communication link, as a liaison channel. But if that entity, if that liaison office is nothing but like a branch only, but having a limited purpose, it is not going to do any business. If this liaison office violates the main purpose for which it is created, it is acting in contravention to the approval given by RBI. It is performing the business activities also. then in that case it can constitute the P. However, if it is engaged only in say primary, it is only in say engaged in collecting the information. It is only printing, let's say, some checks and drafts, dispatching to the customers. So if it is doing some preparatory or ancillary activities or auxiliary activities, it is collecting information, it is doing some preparatory function. Preparatory function meaning what? That some basic functions which lead to the main functions. So before you start your main business, you do a groundwork, preparatory work. So if it is doing preparatory or auxiliary work, auxiliary is some incidental functions which are not profit generating activity. So if it is engaged in preparatory or auxiliary activities, these activities are excluded from permanent establishment. So from this definition of permanent establishment, this excludes preparatory and auxiliary activities. If the liaison office is engaged only in the as a communication channel, they are not performing any core activity. So, not performing core activities or main business activities, or you can write the profit generating activities, these are excluded. Otherwise, they will be included. So, if they identify new customers, do the pricing negotiation, discuss the commercial issues with the customer, they could result in P. Liaison office, as I said, Namrata is established to act as a communication channel, to act as a kind of for the research functions, for the ancillary functions, incidental functions, to to the customer calls, take the customer feedbacks, or do some market survey, some basic functions which are preparatory or ancillary functions of the business. Are we clear? So that shall not result in the permanent establishment. Yes or no? Any question? Yes? Yes or no? Yes, students, faster. Okay? Yes. So, yes, the difference between the business connection and PE is, see, Namrata, business connection is not defined. It is only saying it includes the dependent agent. It is a not defined concept. Whereas PE is a very defined concept, as you saw in Article 5. Clear? Any other questions? Okay. Now the next important point. So once the business connection or the PE gets constituted, not the entire profits get taxable in India. So let's say, for example, if the non-resident is doing the sales activity in India through a branch. Let's take an example over here. Let's say there is US company. It has a branch in India. This is in concluding the, let's say, contracts and doing sale of goods on behalf of non-resident. Fine. So therefore, P as well as business connection. So students, it is possible that business connection will get constituted in many cases and the PE may not get constituted. Both are not the same, as I said. Business connection is very wide. It's not defined, so it's very wide. Something which is not defined, anything can be included in that, isn't it? But P is a very defined concept. Unless you meet the conditions of the P, unless you fit in one of the clauses of P, P will not get constituted. So it is possible there may be a business connection, there may not be a P. So in that case, what will you do? In that case, the provisions of section 90 say that the Act or the DTAA provision, whichever is beneficial to the taxpayer, will apply. If the DTAA is beneficial, if you are not constituting the P, then the provisions of DTAA will be applicable. Are we clear? Then the provisions of the DTAA will be applicable. Okay? Yes or no? Yes, students? Fine. So basically, now if you look at, let's say for example, I have the PE now getting constituted. So in that particular case, let's say here I am making the sales of 1 lakh. Now the question is, students, whether entire 1 lakh is taxable. Whether entire 1 lakh is taxable? The answer is no. If the business connection or PE is getting constituted, entire 1 lakh is not taxable, students. So then, ma'am, what is taxable? So, both Act and DTAA says, both Act and DTAA says that in case the business connection is constituted or the PE is getting constituted, in case the business connection is constituted or the PE is getting constituted, then only so much of income as is attributable to the operations carried out in India or the activities carried out in India shall be deemed to accrue or arise in India. Ma'am, we didn't understand this point. I know that. Let me explain. So students, if you see here, 1 lakh rupees is the sale value. This is my pre-NL. Here, this 1 lakh rupees is the effort of, let's say, manufacturing, let's say, advertisement, let's say, the purchase of raw material, right? There are 3-4 things involved. Let's say my manufacturing and purchase of raw material, this is in, let's say, China, this is in, let's say, USA, and only advertisement is carried by this branch. So the profit which is arising, this profit in the P&L, first of all, that should be taxable and not the entire sale amount, because it says income and not sales. Entire sale is never an income. For anyone in the world, entire sale will never be income. Students, PGBP, profit and gains from business or profession. What you are doing over here? You are not doing you are doing the business. So you will be assessed under the head of PGBP, right? If you are earning business income, if you have income deemed to accrue or arise in India through business connection or through a PE, the computation will be as per the Income Tax Act. For computation, where will you go? PGBP. Where profit and gains from business or profession carried on by the assessee, which includes the agent of the assessee also. Right? I told you, remember over there also I told you, carried on by the assessee, which includes carried on the business by his agent also. So under PGBP, you are taxing profits and gains, not the sales. What is profit and gains? Determined as per the commercial principles of accounting. It is applicable both to resident and non-resident equally. So first of all, I will tax the profits. Now whether I will tax the entire profit? No. How can India tax the entire profit? Sales is carried out, purchase is carried out in US, manufacturing is carried out in China. US cannot tax the entire profit. India cannot tax the entire profit. Only the advertising is carried out in India. Advertising may be the sales agent's role which is there, which is in relation to the negotiation. So only a limited role is carried out in India, for which you cannot say your entire profit from the sale of these goods is going to be taxed in India. Profit is essentially a function of demand and supply. You have demand in India, but supply side also you need to look at. Manufacturing, which is the main activity, that is not done in India. So why entire profit? So that is why the Act and the DTL both says only so much of income. This is my profit. As is attributable to the operations or activities carried out in India. So in this case, only to the extent of. So profits only to the extent of marketing function deemed to accrue or arise in India. Now you will say, ma'am, how is this going to be determined? For that student, there are different formulas. Yes, Namrata, correct. You need to proportionate as per the activities. So either you take the industry standard, you see what is the profit earned by such customers in industry or such entities in industry, and you apply that profit percentage to the global turnover, or you allocate the global profit based on some ratio, based on the employees, based on the assets. So it has to be apportioned. So basically here, the transfer pricing regulations will become applicable. You determine what is the arm's length profit. Okay. Is this clear, students? Yes or no, my dear students? Yes? Yes or no? Is this clear? Okay. Fine. Now, here there are two more additional things over here, which we have to consider. One is, they are saying, the explanation says that the income attributable to the operations carried out in India. So you saw the explanation 2. Explanation 3 is basically this. This is the explanation 3 to the section 9. Then the explanation 3 says that the income attributable to the operations. Income attributable to the operations carried out in India income attributable to the operations carried out in India includes income from. This we have already done as a part of our digital tax class. Advertisement, which income from the advertisement which targets the customer who resides in India or from a person or a customer who accesses the advertisement, or you can write just, or accesses the advertisement from IP located in India or through IP located in India. Secondly, sale of data collected from person who resides in India or who uses IP located in India. And third, sale of goods or services using data collected from person who resides in India or a person who uses the IP located in India. Are we clear? So this is something which is we have already discussed as a part of the digital tax class, isn't it? So income attributable to the operations carried out in India, meaning the income from the activities in India will include the income from these particular three activities, which is advertisement, which is targeting the customer of India or the one who is accessing the IP in India, sale of data collected from the person. So any advertisement which is targeted towards you or any sale of data which is collected from a person who is Indian or who uses the Indian IP. So the way Instagram is selling your data, Facebook, WhatsApp is selling your data. So if they have a business connection in India, it is not going to constitute a business connection. What they are saying is, if they have business connection in India, if WhatsApp, Facebook has a business connection in India, and they are selling the data of Indian customers or the one who is accessing Indian IP, then the income from the Indian operations will also include the income from sale of data. Or let's say, for example, there's a company which is selling the goods or services on Instagram based on the data which is given by the Instagram to that company. So their income will also be included in the operations carried out in India. Are we clear? Yes or no? Yes? Any questions? Any other doubt? Yes? Okay. The last one is significant economic presence. Again, this is something we have already done. So explanation 2A says that the business connection will also include the significant economic presence. So just write it over here itself. Explanation 2A. Business connection includes Significant economic presence. We have already done what is significant economic presence. So, significant economic presence. A. Transaction in respect of goods, services, or property. Goods or services or property carried out by non-resident with any person in India including the provision of download of data or software. Including the provision of download of data or the software. And what is the prescribed limit which is given for the students? We have already done that. What is the limit which is prescribed? 2 crores rupees. Sorry. Secondly, B. Second is what? Second is in respect of the systematic and continuous soliciting of business activities or engaging in with 3 lakh users. 3 lakh users. Fine. So this is what we have already done in the digital cash class. That if there are transactions in respect of goods, services or property, including download of data or software greater than 2 crore or interaction with the users, it will constitute the SCP and the SCP will be resulting in business connection. Clear? Yes or no, students? Any other question? On email, we get Apple products information that is also targeting Indian customers. Yes, Namrata, it is definitely targeting the Indian customers. Access advertisement through IP located in India. So basically, all the internet protocol which are registered in India, the IP, not the internet protocol registered, I mean the IP addresses if they are located in India. So advertisement which are targeting the IP addresses located in India. So there's a possibility of using the virtual servers, right? Wherein you can change your IP address and all of that. So if there is advertisements which are targeting the person who is accessing through the Indian IP, then in that particular case, the income will be included in the income attributable to the operations. Okay? Yes or no? Any other question? Okay. Now the last one over here is, so we are done with the business connection, if you see. Then the next clause was through or from any property in India. So through or from any property in India basically can include rental. Example you can write here. Rental income. So basically, let's say for example, there is a property situated in India. There is a rental income getting generated from there. So that will be resulting in the income accruing or arising through or from any property in India. Okay. Or for example, your dividends, interest, whatever. So this is even the property is a very wide term. It is not defined. It may not only mean the immobile property, but any kind of rights. But here, more or less, we understand the property as the proper immobile property and therefore we restrict it over here to rental income. Okay. Through or from any asset or source of income in India. So Any kind of income which is generating from any asset, royalties, again dividend, interest, whatever income from any asset or source of income in India through or from the transfer of capital asset situated in India. So if there is a capital gain arising from the sale of capital asset, this will be included in the through or from the transfer of capital assets situated in India. Clear? Yes or no? Now, under the through or from the transfer of capital assets situated in India, students, in the next class, we will be studying what is indirect transfer. We will be studying what is indirect transfer. That is what we are going to look in the next class. Indirect transfer of asset. Yes, Namrata, I will summarize. I will summarize all before we move to the next part. Okay. So through or from the transfer of a capital asset in India, we will study next about the indirect transfer. Now there is certain exclusion also from the section 911. What are the exclusion? The exclusion is purchase of goods in India for export. You can write down here. Exclusions from section 911. Purchase of goods for the export. That is excluded. Collection of news. Collection of news for transmission out of India. Third, shooting of cinematograph films in India. And activities confined to display of rough diamond in SEZ. These are excluded from section 9.1. Okay. So I'll just quickly recap what we have done so far. We have started with section 911, which says income accruing or arising through directly or indirectly through or from any business connection in India. Business connection is not defined, but it has been understood that there is real and intimate connection between the activities carried out in India and the income that is getting generated therefrom. So, under the business connection, explanation 2 says business connection includes dependent agent. Dependent agent means what? Has and habitually exercises the authority to conclude contracts, or habitually concludes the contract, or plays the principal role leading to the conclusion of contract. Meaning he does not conclude the contract, but he is doing all other activities and not just formally concluding the contract, but he is doing all the activities resulting in the conclusion of contracts. So the contracts may be formally concluded by the non-resident company. Okay. Habitually secures the orders mainly or wholly for non-residents and its related entities. Then habitually maintains the stock of goods and regularly delivers therefrom. Exclusion, independent agent broker commission is not a dependent agent if they are acting in the ordinary course of business. But if they are working mainly or wholly for one non-resident or their controlled entities, they will not be independent agent. Right? Under the Act, you have the similar definition as PE. So, under the treaty, the business income or the business profits are taxable only when there is a PE. PE is a defined concept, right? It includes the office, warehouse, sales outlet, whatever. There are different definitions: dependent agent, construction site, installation activity, services through employees. The independent agent is excluded there under me. It's basically a fixed place of business through which the non-resident carries out the business. in the other country. Now, the business profits will be taxable in the source country only to the extent of the income attributable to the operations carried out in India. So not the entire sales amount, not the entire profits will be taxable, but only those business profits shall be taxable which are attributable to the activities or operations carried out in India. Are we clear? And this will include the sale of the advertisement targeting the Indian customers or the person who accesses the IP in India, the sale of the data collected, income from the sale of data collected, or the third one, sale of goods or services using the data collected of Indian customers. Clear? Business connection includes the SEP. SEP is transaction in respect of goods, services, or property with more than the turnover of rupees 2 crores, right? Including the download of data or software, or systematic and continuous soliciting of business activities, or interaction with more than 3 lakh users. Okay, so with SCP, there is a done away with the concept of doing business in India versus doing business with India. Why? Because SCP is what? That I am sitting outside India. I am not coming and establishing a presence in India. Despite that, I am able to do the business in India. So earlier, for doing business in India, business connection was required. Doing business in India was required to tax the business income. What is business connections? Doing business in India. You show some presence in India, only then I can tax your business income. However, the SCP concept says even if you are doing business with India, by not maintaining any physical presence, but if you have an economic presence, a significant economic presence, then also you will have the income deemed to accrue or arise in India. Are we clear, students? Yes or no? So will you please revise this? If you have any questions, I'll wait for your question. Otherwise, we'll close the session today. Yes or no, students? Yes. Any questions you have? Okay. Okay, students, so if there are no further questions, we can just close here for today and we'll meet in the next class. Thank you so much. Yes.